This chart goes all the way back to 1980, and this is looking at the S&P 500, looking at the bottom of the barrel where the red numbers are how far down from top to bottom we went in 1 year. So going to the far right of our screen with my mouse, at one point this year we were down 19% on the S&P 500 from the tippity top in February down to the bottom at the beginning of April. And so far it's recovered back. Now this is plus 13 because this chart is through October 15th. So a little bit different than the 930 chart we looked at previously, but it just shows the resilience of the stock market over time if you're patient. What we're seeing is a pickup in fraud with using artificial intelligence, not only in email, because they're able to utilize LLMs to sound more believable, but also in audio and video, where you may get a phone call from a number you don't realize, and it's someone impersonating someone that is real, but this is actually artificial intelligence.
I know, Chad, I'm getting phone calls all the time, and you never know if it's daycare, so you got to pick it up, and no one answers the phone. It's just quiet. So I'm convinced that they're trying to record my voice for, one of these bad actors to use in that manner. It just seems rampant nowadays.
Mm-hmm. I mean, it is wild. Are you taking steps to help protect against that personally, Yesenia?
Yes, when I get that phone call, I don't talk. I just say hello and wait. I don't keep talking after that. But really, another scam that we're seeing all the time is people calling, like you've mentioned, someone's using your audio or your video to call a family member and say that you're in trouble, they're demanding money or something like that. Or they're pretending to be a government agency. You haven't paid your tolls. Goodness knows, if you look through my phone, I haven't paid any of my tolls in the last few years. They make it seem that way, and it's very urgent. So our best advice to help protect against this is to just hang up the phone and call the source. They're always going to make it seem like you can't call back. They need an answer right away. Just hang up. If someone is putting a lot of pressure on you to give you a quick answer, it's very likely to be some sort of AI fraud or scam. So just hang up the phone, call the source. Know that government agencies are not going to text you or call you. They're going to send out old-fashioned snail mail. That's how they're going to contact you. So this happened with my own aunt via Medicare. They knew that she had just gotten her Medicare card and wanted her number to activate it. And so what did she do? She gave them the number to activate it because she wanted to make sure it still worked. Thankfully, it's Medicare fraud. They're not taking money out of her account, but still, right, that could have easily been her social security number, things like that. It's very believable. So just hang up the phone, call the source as a way of double checking. Another way is to have a safe word with your family. Hey guys, family meeting. If something happens and you need to verify whether it's me, this is the word you ask for. Have a passcode. My mother-in-law actually sent us out one a couple of months ago, and she said, if anything happens, this is our family safe word. And we all thought it was hysterical, but she told us why, and we're like, oh, it's actually a good idea. So highly recommend all families have one in place as well.
And what's really interesting is that JP Morgan said that artificial intelligence capital expenditures added 1.1% to GDP in 2025, which is roughly a third of our GDP is just in AI spending right now. So it's really helping. The good thing also about this is a lot of these spending, their commitments, and they're not slowing down. So we are expecting this to continue for the next several years because these are contracts that are locked in for the most part. So that's really nice. And AI spending is not slowing, but there is a tale of two economies where you have the AI spending, which is propping things up, and then the deceleration we're seeing on other parts of the economy. But net, we're still really positive on GDP growth, and we don't see a recession over the next 12 months because of it. It's just a different economy than we had in the past. We saw this bubble up a year ago, and it's becoming more and more of an issue in portfolios. And that is the top 10 companies, if you can see my mouse, are now making up 40% of the S&P 500 per market cap. So when you think about, oh, I've got this money that's going to the S&P, this is this nice diversified basket, $4 out of every 10 you put in the S&P is going to 10 companies now. And a lot of these companies are interlinked. They're in the same business. We're talking Meta, Apple, Amazon, Google. They're all big tech companies. So this speaks louder than anything else that I can really come up with, and the importance of diversification into international and different market and different like small cap and mid cap stocks and portfolios, just to diversify away from this concentration risk that we're seeing in portfolios. We're going to move on to just the Federal Reserve. What's going on in the Fed? You maybe have heard that interest rates are coming down, and we are seeing that. Rates are coming down. The Fed is going to cut, and they're continuing to cut rates. We think they're going to cut another quarter point here in the next week or two. And there's several different areas we could be in. I think we're personally in the top left sector of this, where the Fed is cutting rates and there is no recession within the next 12 months. And that happens at about 5% of outcomes. Now, most of the time the Fed is on pause and the economy is kind of churning along and there's no recession. But as of right now, the Fed is moving rates and they're cutting rates. And in this scenario, it's the strongest return on stocks that we've seen when you look at all previous historical metrics. Now, you can't say that past performance does not equal future returns, but this is a nice hint as the risk return that we may be taking when, even if there is a recession, stocks in the last 7% of time periods were only down 1.9%. So we're not forecasting a recession, but bonds have historically performed well in both scenarios. And most portfolios have a combination of stocks and bonds in them. All of our portfolios do, and they will benefit. The bond portfolio will likely benefit from this because when Fed cuts rates, bond prices move up and move higher, generally speaking. And so I think this is really nice and a really good news for just overall, just the message of staying invested and sticking to your plan, because we don't know the timing of returns. We don't know when it's going to happen, but over time, over a long period of time, stocks do well, bonds do well, and that makes plans do well. It's just our job to manage the risk and return profile. This chart shows what the market expects certain asset classes, the volatility and measure of that. So up and down movements, it's saying. Now, when you go back to 2020, the market said, wow, we have COVID. Stocks are going to move a lot. That's what that means. That's the orange. The orange is the S&P 500. Purple here is gold as an asset. When COVID happened, the market said, hey, stocks are going to move a lot. Gold is also going to move a lot just because everything's moving a lot, but still less than stocks. And historically, we're seeing, yes, that's the case most of the time, that stocks are a more volatile asset class, the S&P 500, than gold is. There were some little tidbits where gold may have done a little bit. However, what we're seeing is, I think, really interesting, where gold has really run up a lot, where the market is saying, hey, stocks are going to be about historically where they were. However, we think gold is going to be more volatile than what we've seen going back to COVID. That's what it's pricing in right now. So it's almost like it's saying, hey, this asset is going to move a lot in price. And that nice smooth price return that you're used to in gold, that's not really going to happen here. And so even though it's up 62% year to date, it's pricing in higher movements for gold and stocks, which if I were an investor and thinking, wow, I'm going to risk off and buy gold, you're kind of doing the opposite here with what the market's pricing in, where it's saying it's riskier from a up and down price movement perspective.
So we did get a question. Do you have any comments about the investment in annuities, and do you recommend them? And so great question, one that I get often. For most people, I think annuities can be a very expensive way to get that stream of income. That's generally how they're sold. It's a guaranteed stream of income. They're low risk, not subject to the market. Some of them are, not all of them are. So I think it's very unique to a person's individual situation. I think they can be great for those who maybe spending is an issue. If we just have full access to a full portfolio, we're just very tempted to take more and more to a point where it's not sustainable. Maybe it is a better idea to have some in an annuity and we're living off of a fixed income. I think that could be really good for some people. I also have some clients that the only reason they can deal with the volatility of a portfolio is because they do have some annuities on the sidelines. They know that they can tap into those if they need to. And that helps them sleep at night when the markets do get a little bit volatile. They just weren't very used to investing, so they have a bit of a mixed strategy. So I think in some circumstances, it does make sense, but it can be a very expensive way to access the market. I have some clients who say they're very safe, they're guaranteed. Not the indexed annuities. They are subject, the actual product is invested in the market, the same thing that they were trying to avoid. And so I think when it comes to annuities, it's just very important to understand what an individual's goals are, what are we trying to achieve, and what's the best product for that. You know, we're not a huge fan of products because they're expensive. Products have additional fees and commissions that we like to avoid. We're fee only, we don't sell any of these, but they do have a place in some people's portfolios. So it really just comes down to the goals. What are we looking to achieve? And again, how do we minimize costs? That's one of the things we can control. We want to minimize cost. Annuities can be expensive. So we want to see what the different trade-offs are. So I have to give the non-answer of it depends. Great for some people, not so great for others. But highly recommend you reach out if you have specific questions about your situation. I'd be really happy to go into more detail and see if that's something that works for you.